Hey, Zuber, with job reports or the bigger one, BLS, coming out tomorrow, what do you think is going to happen if we see expectations missed or if expectations are exceeded? And what will happen to mortgage rates?
Oh, that second piece is the money question. So let's catch people up on what's happened already this week. So each and every month, we get three jobs numbers, and it's typically within the first calendar week of a month, such as today. So the first one that comes out is called the JOLTS report, basically job openings. And job openings, to say disappointed would be an understatement. So to catch people up, last month we were at 7.6. They were expected to go to 7.4, and they came in at 7.1 million job openings. Now, without context, people might not know what does 7.1 million mean. One, it's the second lowest number we have seen since 2021. Again, so that's not good. But more importantly, and most people miss this, Dustin, we now have, for the first time since the pandemic, more unemployed Americans than job openings. Hello, recession. So when the JOLTS report came out and people digested that number, you saw bond rates fall. And as I saw it yesterday at the close, we saw for the first time the 30-year mortgage rate come in below 6.5. It came in at 6.49, which is the low of the year as of yesterday. Okay, great. So that's the first number. What happened today? The ADP report came out, which is private payrolls. It was expected to come in around 75,000 after last month being at 106,000. It too disappointed, coming in at 54,000, a huge miss to the downside. It has already caused the bond market, the 10-year, to fall to 4.18, 4.18. I expect mortgage rates to hit yet another year low today, probably 6.47-ish, something like that at the end of the day. Would not shock me. But to your question, tomorrow's the big boy. And tomorrow's the big boy for two reasons. One, we're going to see how bad the revisions were to last month. Because again, remember, last month was horrible at like 77 or 67,000 or whatever it was. If we get a similar revision to the previous month, it is possible, Dustin, that July goes negative. And that will be ugly. But that's only step one of this equation. The other thing that comes out tomorrow is their yearly adjustment. Now, you'd have to have a good memory. Thankfully, I do. Last year's yearly adjustment was a negative 818,000 jobs disappeared, never existed. So tomorrow could be very ugly. If we go 3 for 3 with horrible misses, and I would argue 4 for 4 with a horrible revision, it is possible that the 10-year note breaks 4.1 tomorrow. Because again, JOLTS is interesting, ADP is interesting, but the big kahuna is the Bureau of Labor Statistics, which comes out tomorrow at 5:30 a.m. Pacific, come Friday. And if it is as ugly as I think it will be, because I'll say this right now, I think the adjustment's over 1 million. I think it's bigger than last year. And that's just going to be a huge red flag and, flag on the play, and the Fed's going to be forced. And as I've said, Dustin, for 6 weeks now, I think the Fed cuts 50 basis points in September 17th. And that either gets cemented tomorrow or I'm just flat out wrong and they cut a quarter only. So now what happens to mortgages, which is really what we care about here? I think if the number is as ugly as I expect, we could see mortgage rates break 6.4 by end of business tomorrow, which would be a pretty significant move for a single day, but also set us up for a move to 6.25 by the next 30 to 45 days. Because I think it's pretty clear if you step back from the chart and zoom out, rates are slowly going down. But here's the deal. What most people miss, you probably know this, the 10-year really hasn't moved that much except for this week. It's been the spreads that are getting tighter. So if you add in tighter and tighter spreads and a falling 10-year, we could be at 6.25 by October 15th. So that's that. If we go the other way, and let's just play for a minute that I'm completely off base and wrong, and the job market is strong. I mean, I don't believe it. I don't think anybody does, but let's just say for a minute it is. And tomorrow we expect, I think it's 75,000 jobs. And let's say we get 125,000. And oh, by the way, the revisions are expected to be 800,000. And let's say they're 500,000. So again, we're playing the complete opposite. I think the 10-year firms, because now we have a cross current of data. I think there's a lot of people that flat out don't trust the Bureau's numbers because they keep getting revised left, right, and center. But I think if we get a positive number, a big beat by 50,000, rates stop falling for sure, because then it's all about inflation next week. We get PPI on Tuesday, we get CPI on Wednesday. And, the last couple of readings on those have not been good. So, yeah, it's going to be interesting. I do think there's a path to rates heading down. I think that's the trajectory we're on, but it could reverse.
Do you think what's a bigger impact on mortgage rates right now? Would you say it's the job market or inflation? Because that's
Jobs.
teetered, right?
Jobs. 100%.
So we've seen that.
It's jobs. It's all jobs.
And it hasn't always been that.
No,
I haven't missed that much.
No, I would argue Jackson Hole. Yeah, the Jackson Hole speech in August was the first clear sign of Powell himself saying jobs over inflation. I think if you go back to the last Fed meeting when you had Christopher Waller and Michelle Bowman both vote against pausing, right? They wanted to cut. I think that was the first time you saw the Fed presidents wake up saying jobs over inflation. I think tomorrow could be so bad that it's all of the Fed jobs. I mean, the only way we get a 50 basis point cut, which again is, let's be clear, I'm the only idiot calling for that right now. Not even the Fed watch tool has a 0% chance. So I'm like a man on an island.
It was zero? I was going to
zero for 50. Yeah. As of this morning, zero. But if tomorrow is ugly, you're going to see that number shoot up. And I think I really do think it's going to be ugly.
Yeah. And I think to touch on what you said at the beginning, when was the last time that we had more or higher unemployment, right, numbers than job openings? When was the last time it happened?
So if you take out those few months around the pandemic, which it's not a fair comparison. So if you remove like March to June of 2020, which is, we shut the country down, that doesn't count. You got to go back to the GFC. It's a long time.
Yeah. I mean, that's a scary thing to think about. Now there's always two sides to it, but if you are waiting on mortgage rates to come lower, are you telling people to lock now, or are you telling them wait 2 weeks or wait a month?
I'm an investor, right? So I'm always, if you like it, lock it, because you should be rewriting numbers that fund today. If you were to ask me if I'm refining and, I'm on that borderline, I might wait. Again, we're going to know tomorrow. It's a day away, right? But actually, by the time this posts, it will already be out, because I think this will post on Saturday. So it'll be done. But yeah, it'll be interesting to see if I'm right or wrong, because I'm going to either be spectacularly right or spectacularly wrong.
So it'll just to confirm, you're still betting on the fact that tomorrow's job reports are going to come in weaker.
Oh, much weaker.
It's going to be a big mess, and that rates will be lower by the end of the day tomorrow. So will the audience be able to tell me how I did, right? We're recording this Thursday at 9:17 a.m. Pacific Thursday. I am telling you that 5:30 a.m. Friday Pacific is going to be ugly, and that mortgage rates will be lower Friday than they were Wednesday, just to put it clear as day. I'm not disagreeing, but I'll start with, look, all of the tightening of the spreads that you hit on earlier was 100% spot on, because I priced out, and John and I did, we do these how many times a day, but hold on to your, seats here. Conventional primary right now, through some of our portfolio options where they'll service it themselves, fund it themselves, etc., balance sheet it, all that. I mean, you can pay just under 1 point right now and get 4.99 on a primary.
Shut up.
Year fixed. The rate sheet is now open to 4.99. This happened 2 days ago. You're paying points where you can't say average 30 fixed rates 4.99. No.
So 4.99.
Yeah.
So I'm
That's on our rate sheet
guessing
now.
20% down. I'm just
This is
guessing.
just with your typical 20%, 30-year fix, 740 credit, white picket fence, not jumbo, just, 650K loan in Los Angeles. Well, yeah, somewhere maybe outside of Los Angeles. But our rate sheet hasn't been open to 499. Like rates in terms of the drop, right, from the average kind of
I
the
would not
just
wait.
are.
Let me be very clear to your other question. I would take 499 and lock it up
I'd be done.
ASAP.
Yeah, you don't
Done.
have to worry about it. Like I'm set,
No, no.
499, 4.99. I mean, and then investment for all the majority of the listeners on this channel, you can get to, 5.3.
Shut
Yes,
up.
it's full doc. It's not, DSCR, but 5.3 now with just under a point. So it's like, I think obviously the market makers, but in the mortgage side of things, right? Not
Yeah.
your typical market makers, they've realized that, look, if we just tighten the spreads a little bit, right, with what we've had for the last 4 years have been so fat and so cushiony,
Yeah.
like this is what we needed. This is the spur we'll get, consumers to fly through the doors. Because
I have said for a year, maybe even 18 months, if an owner occupant loan ever sniffs 499, it's going to go batshit crazy.
yeah,
And you're telling me we're there now.
you can get it right now. Somebody could call us, want to buy their first home, they pay a point and they have 740 credit with 20% down, they can get 4.99 on a conventional loan, not an FHA, not a VA loan, but conventional.
You know what's really funny? I'm sitting in a house right now that I actually was proud that I beat up the builder to give me a 30-year fixed rate at 499. Now you're telling me it's nothing special. Thanks.
At the time it was, but the
It
better
was, yeah,
part
because
is
they
you
were
had the
8.
builder pay for it. I'm just
Exactly.
saying, look, the seller can pay for it, but yeah,
Yeah.
499. I've said it for the last 2 years. We wouldn't sniff anything with a four handle. Yes, it's 499, not 47
It
or
doesn't matter.
whatever. It's 499. That you market that, you tell homeowners that, you tell people on the sideline 499 instead of even 5.1. There's a dramatic difference, mentally, emotionally, if you say 499 versus 5.1.
Folks, you heard it here first. You got to reach out to Convoy. How do they do that?
Go to our website, convoyhomeloans.com. Just make sure you mention that you came from ORAT in a little drop down menu.
Yep. How'd you hear of us? Tell me you came from ORAT. Why do you have to do that? Because you want to talk with this man or his partner, Jonathan, directly. You don't want to be in a queue. You don't want to be like everybody else. You're special because you listen to ORAT. So go ahead and tell them you came here and they'll take care of you. Thanks, buddy.
Thank you.